Geography, Project Report, and Finance. K1. Projected financial statements, its limitations, meaning, and overview. S25. 1. Projection of financial statements means estimating or forecasting the future income statement, balance sheet, and cash flow statement of a business. 2. These projections help management to see what the company's financial position might look like in the future based on current trends and expected performance. 3. The projected financial statements summarize future income, assets, liabilities, and cash flow. This helps managers plan and make informed decisions. 4. It plays a vital role in business planning as it forecasts how the company will perform financially in the coming months or years. 5. Financial projections are based on assumptions, usually taken from past financial data, experience, and knowledge. 6. All businesses, new or existing, need projected statements to present to investors, banks, or creditors. 7. They are also useful in business planning, growth strategy, budgeting, and attracting investors. 8. For new startups, projected statements are essential parts of a business plan to show the company's future potential. Types of projections based on duration. 1. Short-term projections. These usually cover 1 year and are divided into monthly or quarterly plans. They are used by small businesses to focus on short-term goals like increasing sales or controlling costs. Example, estimating next year's sales, expenses, and profit. 2. Long-term projections. These cover 3 to 5 years and are used by large organizations for long-term planning. They help in strategic decisions like expansion, new investments, or diversification. Example, planning for a new factory or market expansion in the next 5 years. Importance of projected financial statements. 1. Helps to find additional requirements. It identifies how much extra finance or assets will be needed to achieve the company's growth goals. 2. Predicts future outcomes. The company can estimate its future profits, losses, and financial position before they happen. 3. Supports business planning. Managers can prepare budgets and financial plans using these projections. 4. Helps in business growth. It helps in finding out how much debt or equity will be required for expansion. 5. Ensures smooth cash flow. Projections prevent the business from running out of cash by forecasting future income and expenses. 6. Useful for applying loans. Banks and financial institutions ask for projected statements before approving any business loan. 7. Helps creditors and investors. Creditors use these statements to check if the business will have enough funds to repay debts. Investors use them to analyze profitability and return potential. Steps to create projected financial statements. 1. Check supplier bills. Make sure all supplier invoices match your records so no expenses are missed. 2. Check customer invoices. Confirm that all sales are billed and recorded correctly. 3. Add unpaid salaries. Record any employee wages that are earned but not yet paid. 4. Calculate depreciation. Reduce the value of fixed assets to show their wear and tear over time. 5. Count inventory. Take a physical count or estimate your closing stock to find the cost of goods sold, COGS. 6. Match bank accounts. Compare your books with the bank statement and fix any differences. 7. Update account balances. Post all updated figures from subledgers, like payables and receivables, to the general ledger. 8. Review accounts. Check if all balances are correct and adjust them through journal entries if needed. 9. Review financial reports. Prepare a draft of the financial statements, correct errors, and finalize them. 10. Record income tax. Estimate and enter the tax amount based on your profit. 11. Close and open accounts. Close the books for the current period and prepare for the next one. 12. Prepare final statements. Make the final financial statements with notes and a cover letter, then share them with management, investors, and banks. Asterisk limitations of financial statements, S25. Even though financial statements are useful, they have some limitations. 1. Based on historical cost, they record assets and liabilities at their original cost, not current market value. 2. Not adjusted for inflation. The value of money changes over time, but statements do not reflect inflation. 3. Do not include intangible assets. Non-physical assets like goodwill, brand value, and employee skill are often ignored. 4. Covers only a specific period. Statements show results for a limited time and may not give a full long-term picture. 5. May not be comparable. Different accounting methods between companies make comparison difficult. 6. Could be biased. Management may present data in a way that looks more favorable. 7. Do not cover non-financial issues. Factors like employee satisfaction or environmental impact are not included. 8. May not be verified. If not audited, there may be errors or manipulation in the data. 9. No predictive value. Historical financial statements cannot always predict future performance accurately. In simple summary, projected financial statements are future estimates of income, expenses, assets, liabilities, and cash flow. They are useful for planning, decision-making, attracting investors, and getting loans. Short-term projections are for 1 year, while long-term ones are for 3 to 5 years. They help predict the financial future of a company, but still have limitations like being based on assumptions and historical data. K2. Balance sheets, its components and preparation. A balance sheet is a financial statement that shows a company's financial position on a specific date. It reports 3 main things. 1. Assets. What the company owns. 2. Liabilities. What the company owes. 3. Shareholders' equity, capital, the owner's claim or investment in the company. The balance sheet is one of the 3 core financial statements, along with the income statement and cash flow statement, which are used to evaluate a business. It gives a snapshot of the company's financial condition at a particular point in time, for example, as of March 31st, 2025. Accounting equation. The balance sheet follows the fundamental accounting equation. Assets equals liabilities plus shareholders' equity. This means everything the company owns, assets, is financed either through debt, liabilities, or by owners' equity. Example: if a business owns Indian rupee 10,000,000 in total assets and owes Indian rupee 6,000,000 in liabilities, then the owner's equity will be Indian rupee 4,000,000. Main components of a balance sheet. 1. Assets. These are valuable resources owned by a business that can generate income in the future. Current assets, cash, accounts receivable, inventory, easily converted to cash. O. Fixed/non-current assets, land, buildings, machinery, vehicles, patents, etc. 2. Liabilities. These are the company's financial obligations or debts owed to others. O. Current liabilities, short-term debts payable within 1 year, e.g., accounts payable, short-term loans. O. Long-term liabilities, debts due after 1 year, e.g., bonds payable, mortgages. 3. Capital or shareholders' equity. This represents the owner's investment in the business plus retained profits. It shows how much of the company is financed by the owners rather than creditors. Importance of a balance sheet. 1. Shows financial health. Helps investors, creditors, and other stakeholders know how strong and stable the business is financially. 2. Measures growth. By comparing balance sheets from different years, one can see how much the business has grown over time. 3. Loan requirement. It's a key document needed when applying for loans or financial support from banks or investors. 4. Helps in performance analysis. Stakeholders can understand the company's performance and liquidity position, ability to pay short-term debts. 5. Aids decision-making. Useful for making decisions about expansion, investments, and handling unexpected expenses. 6. Shows financing method. It reveals whether the company's operations are funded more by profit, equity, or debt, liabilities. Steps to prepare a projected balance sheet. 1. Pick the balance sheet date. Decide the specific date for which the financial position will be shown, e.g., March 31st, 2025. 2. List all assets. Write down all the asset items starting with the most liquid ones, cash, accounts receivable, inventory, less liquid. 3. Add up all assets. After listing each asset category, calculate the total and record it as total assets. 4. Determine current liabilities. List short-term debts due within a year, such as accounts payable short-term. Loans, accrued expenses. 5. Calculate long-term liabilities. List obligations due beyond 1 year, including bonds payable, long-term loans, pension or mortgage liabilities. 6. Add up liabilities. Add the total current and long-term liabilities to find total liabilities. 7. Calculate owner's equity. Find the total of shareholders' funds, which include share capital, money invested by owners, retained earnings, profits kept in business. Verify the accounting equation. Finally, check if assets equals liabilities plus owner's equity. If both sides match, your balance sheet is correct. If not, review your entries and calculations. Summary: a balance sheet is a key financial statement that shows what a company owns and owes at a specific point in time. It helps assess financial stability, business growth, and funding structure, making it an essential tool for management, investors, and creditors alike. A funds flow statement is a financial statement that shows the changes in the financial position of a business between the beginning and ending dates of a financial period. Period. It explains how funds were obtained, sources, and how they were used applications during a specific time, such as a month, quarter, or year. In simple words, it shows where the money came from and where it went. Meaning of fund flow. Fund flow refers to the movement of funds, money, in and out of a business during a given period. It reflects all the cash inflows and outflows related to various financial activities of the firm. The performance of assets or investments is not considered here, only the movement of money, inflow and outflow, is analyzed. Net inflow of funds increases available cash for investment, while net outflow reduces it. Generally, fund flow is studied on a monthly or quarterly basis. Importance of a funds flow statement. 1. Shows financial changes clearly. It explains how different transactions affected the company's financial position and working capital during the period. 2. Helps answer financial questions. It helps in understanding questions like, why are current assets low even when profits are high? Oh. Why can't the company pay more dividends even though it earned good profits? 3. Guides dividend policy. Sometimes a company may have good profits, but not enough cash to pay dividends. A funds flow statement helps management decide how much dividend can be safely distributed. 4. Helps in planning and decision-making. A projected, future, funds flow statement helps management plan how to use limited financial resources efficiently. 5. Acts as a future guide. It helps management prepare for future financial needs and control the movement of funds properly. 6. Improves working capital management. It shows how effectively the management has used working capital, current assets, current liabilities, and suggests improvements. 7. Indicates creditworthiness. By showing how funds are generated and used, it helps assess the financial stability and creditworthiness of the company. Steps to prepare a funds flow statement. 1. Determine the change in working capital. Compare current assets and current liabilities at the beginning and end of the period to find whether working capital has increased or decreased. 2. Adjust net income. Make adjustments to net income for non-cash items, like depreciation, loss/gain on sale of assets, to calculate funds from operations. 3. Analyze non-current accounts. For each non-current, fixed, asset and liability account, find out if there is an increase or decrease, and classify it as a source or use of funds. Example: sale of equipment, source of funds. Purchase of equipment, use of funds for. Verify the statement. Add up all sources and uses of funds. The net result should be equal to the change in working capital found in Step 1. General rules for preparing a funds flow statement. Transaction. 1. Increase in current asset. Effect on working capital. Increase plus in working capital. 2. Decrease in current asset. Decrease in working capital. 3. Increase in current liability. Decrease in working capital. 4. Decrease in current liability. Increase plus in working capital. 5. Increase in both current asset and current liability. 6. Decrease in both current asset and current liability. No change. No change. 7. Changes in fixed, non-current, assets or liabilities. Affect working capital. Summary: a funds flow statement is a tool that helps analyze how funds were generated and used during a specific period. It helps management, investors, and creditors understand changes in financial position, causes of increase or decrease in working capital, efficient utilization of financial resources. Hence, it plays a key role in financial planning, analysis, and control. K5. Explain cash flow statement, its component. S25. A cash flow statement, CFS, is a financial statement that summarizes the cash and cash equivalents flowing into and out of a company over a period, e.g., a quarter or year. It shows how well the company generates cash and how that cash is used. The CFS complements the balance sheet and the income statement by focusing only on actual cash movements. Meaning a cash flow statement shows the cash inflows, receipts, and cash outflows, payments, of a business during a specific period. It tells where cash came from and where it was spent. Purpose/objectives S25. 1. Measure cash, shows actual cash inflows and outflows. 2. Plan finance, helps management decide how to arrange or use funds. 3. Classify activities, separates cash flows into operating, investing, and financing. 4. Forecasting, helps predict future cash needs. 5. Assess liquidity, checks ability to pay short-term debts. 6. Assess solvency, checks long-term financial stability. 7. Decision-making, helps investors, creditors, and managers make better decisions. 1. Operating activities cash from the company's main business operations. Examples. Cash received from customers. Cash paid to suppliers and employees. Taxes and interest paid or received tells if core business is generating cash. 2. Investing activities cash used for buying or selling long-term assets. Examples. Purchase of machinery or equipment cash outflow. Sale of fixed assets cash inflow. Loans given or collected shows how the company invests for future growth. 3. Financing activities cash between the company and owners or creditors. Examples. Issue of shares or loans cash inflow. Repayment of loans, interest, or dividends cash outflow shows how the company is financed and how it returns money to owners. 2 methods to prepare the operating section. 1. Direct method, list actual cash receipts and payments. Example, cash from customers, cash paid to suppliers, wages, taxes, etc. White heavy check mark advantage, easy to understand. Used by small businesses. 2. Indirect method, start with net income and adjust for non-cash items. Add depreciation/amortization. Working capital changes, adjust for changes in assets and liabilities. Non-operating items, remove gains or add losses on asset sales. Advantage, common and connects income statement with cash flow. Used by most companies. Working capital adjustments, indirect method. Change. Current assets, e.g. receivables, inventory. Effect on cash. Current assets. Subtract cash used. Add cash source. Current liabilities, e.g. payables. Current liabilities. Add cash source. Subtract cash used. Non-cash items. Item. Depreciation/amortization. Treatment. Loss on sale of asset. Add back. Add back. Gain on sale of asset. Subtract. Steps to prepare a cash flow statement. 1. Collect balance sheets, opening and closing, and income statement. 2. Separate cash and non-cash items. 3. For operating cash, indirect method. O. Start with net income. O. Add non-cash expenses, depreciation, etc. O. Adjust for working capital changes. O. Remove gains/add losses on asset sales. 4. Add investing activities, buying/selling assets. 5. Add financing activities, loans, shares, dividends. 6. Calculate net increase/decrease in cash. 7. Reconcile. Opening cash plus net change equals closing cash. 8. Review for accuracy. General rules/quick reminders. Depreciation add. Amortization add. Gain on sale of asset subtract. Loss on sale of asset add. Receivables/inventory subtract. Payables add. Purchase of fixed asset investing outflow. Repayment of loan financing outflow. Worked example. Net income equals 50,000 Indian rupees add. Depreciation 5,000 Indian rupees, receivables 2,000 Indian rupees, subtract inventory 1,500 Indian rupees, add payables 3,000 Indian rupees add. Operating cash flow equals 57,500 Indian rupees. Topic. Meaning. Details. Shows cash inflows and outflows during a period. Tells where cash came from and where it went. Purpose. Check liquidity and solvency. Assess cash generated from operations. Plan. Investments and financing. Reconcile cash balances. Components. 1. Operating activities. Cash from main business. 2. Investing activities. Buying/selling long-term assets. 3. Financing activities. Cash from owners/loans, dividends, repayment. Operating activities, direct method, list actual cash received and paid, e.g., cash from customers, cash to suppliers. Operating activities, indirect method, Start with net income, add non-cash expenses, adjust working capital, remove gains / add losses, get cash from operations, working capital adjustments, current assets, subtract, use, current assets, add source, current liabilities, add source, current liabilities, subtract, use, non-cash items, depreciation / amortization, add loss on sale of asset, add gain on sale of asset, subtract investing activities, cash outflow, purchase machinery / assets, cash inflow, sale of machinery / assets, financing activities, cash inflow, issue shares, take loans, cash outflow, repay loans, pay dividends. Steps to prepare 1. Collect balance sheets and income statement. 2. Separate cash versus non-cash items. 3. Adjust net income for non-cash items and working capital. 4. Add investing and financing cash flows. 5. Compute net increase / decrease in cash. 6. Reconcile with opening and closing cash. Key exam points. 1. Focus on actual cash. 2. 3 sections: operating, investing, financing. 3. Use indirect method. 4. Adjust for non-cash and working capital. 5. Always reconcile with balance sheet summary. A cash flow statement shows where cash came from and how it was used over a period under 3 headings: operating, investing, financing. 2. Comparison. Funds flow statement versus cash flow statement. Points: funds flow statement, cash flow statement. 1. Meaning shows movement of funds, changes in working capital during a period. Shows movement of actual cash and cash equivalents during a period. 2. Focuses on sources and uses of funds. Focuses on cash inflows and outflows. 3. Basis based on working capital concept, current assets, current liabilities. Based on cash basis, actual cash transactions. 4. Objective to find how funds were generated and used. To find how cash was generated and used. 5. Period of use usually prepared monthly or quarterly for planning and analysis. Usually prepared annually or quarterly for cash management. 6. Components. 7. Non-cash items. Deals with changes in working capital, sources, and uses of funds. Includes non-cash items like depreciation for fund calculation. Divided into operating, investing, and financing activities. Excludes all non-cash items, only real cash considered. 8. Opening and closing. Compares opening and closing working capital. Compares opening and closing cash balances. 9. Purpose. Helps in long-term financial planning and fund utilization. Helps in short-term cash management and liquidity control. 10. Usefulness. Useful to understand. Changes in financial position and working capital management. 11. Example of source. Issue of shares, sale of assets, long-term loans. Useful to understand cash position, liquidity, and cash availability. Cash sales, loan received, sale of fixed assets. 12. Example of use. Purchase of machinery, repayment of loans. Payment of salary, purchase of asset, dividend payment. Fund flow statement equals where did the working capital come from and where did it go? Cash flow statement equals where did the cash come from and where did it go? K6. Detailed Project Report, DPR, its content and objectives, S25. 1. After the planning and designing stage of a project is completed, the next step is to prepare a detailed project report, DPR. 2. A DPR is a complete and in-depth document that gives a clear idea of how the project will be carried out. 3. It includes all important information such as the resources, financial plans, and tasks needed to make the project successful. 4. It serves as the main report for deciding whether to invest in the project or not. 5. The investment decision is taken based on the data and analysis provided in the DPR. Steps before preparing DPR. 1. The first step is to conduct a feasibility study where the needs and goals of the project are analyzed. 2. After the feasibility study report is prepared, it is reviewed by experts in the concerned department. 3. If there are any differences or suggestions, the report is modified and improved accordingly. 4. Once the feasibility study is approved, the preparation of the detailed project report begins. 5. DPR helps to finalize and firm up the project proposal before implementation. Contents of a detailed project report. A DPR should contain the following details. 1. Brief information about the project, overview, objectives, and purpose of the project. 2. Experience and skills of promoters, details of the people or team involved in promoting the project. 3. Details of other industrial concerns, Any previous experience or successful projects handled by the promoters. 4. Project finance and sources of funding, estimated cost of the project and where the funds will come from. 5. Government approvals, permissions, licenses, or clearances required. 6. Raw material requirements, details of materials, quantity, and suppliers needed for the project. 7. Security details, information about securities or guarantees given to financial organizations. 8. Other important information, details about management teams, building layout, machinery, technology, manpower, and timelines. Objectives of DPR. 1. To explain the complete business or project idea clearly. A DPR provides a full description of the project, what it is, why it is needed, and how it will be done. This helps everyone understand the project clearly. 2. To check the project's technical and financial feasibility. It studies whether the project is technically possible, technology, machinery, process, and financially viable, cost, profit, return on investment. 3. To estimate the total cost and required resources. The DPR calculates land, building, equipment, manpower, working capital, and operational costs to know how much money and resources are needed. 4. To assess risks, challenges, and solutions. It identifies possible risks, technical, financial, market, and suggests preventive measures to reduce failures and ensure smooth execution. 5. To understand the market and expected demand. It includes market analysis to check customer demand, competition, selling price, and future growth, helping the project succeed in the real market. 6. To help get approval or funding. A well-prepared DPR is needed for government approval, bank loans, investors, and financial institutions to trust and support the project. Importance of detailed project report. 1. Managing the budget. The DPR helps in planning and controlling expenses so that the project stays within the estimated budget. It allows managers to use financial resources efficiently. 2. Minimizing risks. It helps in identifying possible risks before the project starts. Risks can be minimized by proper planning and preventive measures mentioned in the DPR. 3. Project progress follow-up. DPR acts as a guideline for tracking progress. Managers can monitor if the project is going as per schedule and make corrections if needed. 4. Hold over the project. Higher authorities can control and supervise project activities. It helps them evaluate the performance of team members and ensure quality work is being done. Summary. A detailed project report, DPR, is a complete document that gives a clear picture of how a project will be implemented, financed, and managed. It helps in decision-making, budgeting, risk control, progress tracking, and ensures the successful completion of the project. K7. Project finance and diff types of sponsor. 1. Project finance means providing long-term funding for large projects such as infrastructure, industries, or public services. 2. The main feature of project finance is that the loan repayment depends on the cash flow generated by the project itself, not on the company's overall financial strength. 3. The assets and rights of the project, like land, plant, or contracts, are used as security or collateral for the loan. 4. It is especially attractive because it allows companies to raise funds without showing the debt on their balance sheet, called off-balance sheet financing. 5. Project finance is commonly used for power plants, highways, telecom projects, airports, oil and gas plants, and industrial parks. Types of sponsors in project financing S25. A sponsor is the person, company, or organization that promotes and supports the project financially or technically. There are 4 main types of sponsors. 1. Industrial sponsor. These sponsors are usually connected to industries related to the project. Example, a steel company sponsoring a mining project or a cement company funding a limestone plant. Their goal is to support their main business operations, upstream or downstream industries. 2. Public sponsor. These are government departments or municipal corporations. Their main motive is public service rather than profit. Example, government projects like metro rail, roads, or water supply systems. 3. Contractual sponsor. These sponsors are companies that develop, operate, or manage the project. They play an important role in the construction and maintenance stages. Example, construction or engineering firms that build and operate plants. 4. Financial sponsor. These are investment companies, banks, or private investors who finance the project. Their main goal is to earn high returns from the project investment. Example, private equity firms or venture capitalists. Project financing happens in three major stages. 1. Pre-financing stage. This is the planning and analysis phase before funds are arranged. I. Identification of the project plan. The project plan is identified and studied to check whether it aligns with the financial institution's goals. 2. Recognizing and minimizing risks. All possible risks, financial, technical, or operational, are analyzed. The lender ensures that the project has enough resources to manage these risks. 3. Checking project feasibility. Before investing, the lender examines whether the project is technically and financially feasible. Factors like cost, location, technology, and expected profit are studied. 2. Financing stage. This is the execution phase, where funds are arranged and dispersed. I. Arrangement of finance. The sponsor raises money through equity, own funds, or loans, borrowed funds, from banks or investors. 2. Loan or equity negotiation. Both parties, the sponsor and lender, discuss and agree on the loan amount, interest rate, and repayment terms. Documentation and verification. Legal documents are prepared showing all the loan conditions, project terms, and responsibilities of both sides. 3. Payment. 3. Post-financing stage. This stage focuses on monitoring, completion, and repayment. 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 I. Timely project monitoring. The project manager regularly monitors progress to ensure that timelines and budgets are followed. 2. Project closure. Once all project activities are completed successfully, it is formally closed. 3. Loan repayment. After completion, the project generates income. This cash flow is used to repay the loan and interest as per the agreed schedule. Topic. Details simple. Sponsor. Meaning. Person, company, or organization that supports a project financially or technically. Types of sponsors. 1. Industrial sponsor, connected to related industries, supports core business. Example, steel company funding a mining project. 2. Public sponsor, government or municipal bodies. Aim is public service. Example, metro rail roads. 3. Contractual sponsor, companies developing, operating, or maintaining the project. Example, construction/engineering firms. 4. Financial sponsor, banks, investors, or private equity. Goal is profit. Example, venture capital firms. Project financing stages. 1. Pre-financing stage. Identify project plan. Check alignment with financial goals. Recognize and minimize risks. Financial, technical, operational. Check feasibility, cost, location, tech, profit. 2. Financing stage. Arrange finance. Equity or loans. Loan/equity negotiation. Discuss terms, interest, repayment, documentation and verification. Legal agreements. Payment. Funds released to start project. 3. Post-financing stage. Timely monitoring. Ensure timeline and budget adherence. Project closure. Formal completion. Loan repayment. Cash flow used to repay loan plus interest. 2. Income statement. Profit and loss statement. An income statement shows how much money a business earned and spent during a time, month, quarter, or year. It tells if the business made a profit or a loss. Simple formula, \text, net profit equals \text, total income \text, total expenses. Why it is important. Shows if the business is earning or losing money, helps owners and investors understand the financial performance, used to plan, control costs, and calculate tax. 1. Revenue, sales money earned from selling goods or services. 2. Cost of goods sold, COGS money spent to make or buy the goods. Stock plus purchases minus closing stock. 3. Gross profit, profit before other expenses. Gross profit equals revenue minus COGS. 4. Operating expenses, daily business expenses, rent, salary, advertising, etc. 5. Operating income, profit before paying interest or tax. 6. Other income/expenses, income from interest, investments, or one-time losses. 7. Net profit, net income, final profit after all expenses and tax. Item. Amount, Indian rupee. 100,000. Less, COGS. 40,000. Gross profit. 60,000. Less, operating expenses. 20,000. Operating income. 40,000. Less, other expenses. 5,000. Net profit. 35,000. So, the business earned 35,000 Indian rupees profit. In short, income statement equals shows how much money a business earned and spent. If income, expenses profit. If income, expenses loss. White heavy checkmark Unit 3 Compact Summary Table 1. Projected financial statements. Meaning, types, importance, limitations. Topic. Compact Summary. Meaning. Purpose. Future estimate of income statement, balance sheet, cash flow. Planning, budgeting, forecasting, getting loans, attracting investors. Short term, 1 year, long term, 3 to 5 years. Types. Importance. Predict profits, find finance needs, ensure cash flow, help. Planning. Steps. Check invoices, unpaid salaries, depreciation, inventory, bank match, adjust accounts, prepare final statements. Limitations. Historical cost, no inflation, ignores intangibles, period-specific, non-comparable, biased, non-financial factors ignored. 2. Balance sheet, components and preparation. Topic. Compact Summary. Meaning. Shows financial position on a specific date. Equation. Assets equals liabilities plus equity. Assets. Current, cash, receivable, inventory, non-current, land. Machinery. Liabilities. Equity. Current, payables, short loans, and long-term, mortgage, bonds. Share capital plus retained earnings. Steps. Importance. Fixed date list assets, list liabilities, calculate equity. Match equation. Shows financial health, liquidity, growth, loan eligibility. 3. Funds flow statement, meaning, steps, rules. Topic. Meaning. Compact Summary. Shows changes in working capital, sources and uses of funds. Importance. Steps. Explains financial changes, guides dividend, planning. Creditworthiness. 1. Change in working capital. 2. Adjust net income. 3. Analyze. Non-current accounts. 4. Verify. General. Rules. Current asset plus WC. Current asset. WC. Current. Liability. WC. Current liability plus WC. 4. Cash flow statement. Components and rules. Topic. Compact Summary. Meaning. Purpose. Shows actual cash inflow and outflow during a period. Check liquidity, solvency, cash management. Components. Operating. Methods. Operating, investing, financing activities. Direct cash receipts/payments, indirect net income. Plus adjustments. Key rules. Depreciation plus gain, loss plus receivables. Payables plus steps. Adjust net income at investing and financing net. Increase/decrease reconcile. 5. Funds flow versus cash flow. Comparison point funds flow cash flow focus working capital actual cash basis accrual cash basis purpose long-term planning liquidity management section sources and uses operating investing. Financing opening/closing working capital cash balance 6. Detailed project report DPR. Topic compact summary meaning in-depth document explaining project implementation, cost, resources, feasibility. Steps before DPR feasibility study review revisions approval. Contents overview, promoters, finance, approvals, raw materials, security, layout, manpower. Importance budget control, risk reduction, progress tracking, management control. 7. Project finance and types of sponsors. Topic compact summary meaning long-term financing where loan repayment depends on project cash flow. Key feature off-balance sheet financing, project assets used as security. Sponsors industrial, related industry, public, government, contractual. Construction/operation firms, financial, banks/investors. Stages pre-financing, plan, risk study, feasibility. Financing, arrange funds, negotiate, documentation, payment. Post-financing, monitoring, closure, loan repayment.